Delta and the bull put spread. So a reminder of what delta is. Delta is the rate of change in the value of an option for a $1 move up or down in the underlying stock price. So again, underneath you're going to see a quote here for the QQQ. The share price was trading at 108.45, and we're going to use the May 27th 102 $100 bull put spread as an example. And you can see if we move across here, we see the delta for the 102 strike is minus 0.1300. So you'll notice straight away that deltas are negative numbers for put options. So what does that mean? It means that if the value of the share price of QQQ drops by $1, the value of this put option will actually go up, because if it drops by minus 1 multiplied by the delta gives you positive 13. So the value of this put option will actually go up in value, and vice versa. If the share price of QQQ actually goes up by $1, then this remains negative 13 and the value of this 102 put option drops by 13. So delta is the rate of change in the value of an option for a $1 rise or fall in the value of the underlying stock. But with a bull put spread, we've got two positions to consider. So we need to work out what the net effect of delta is going to be on our portfolio. Just a couple of things about delta. When you have positive delta, it means that you're bullish on the stock and you want the share price to rise. And when you're negative on delta, that means that you want the share price to fall. Two positions to consider with our QQQ example. So we sold the 102 put and we bought the $100 put. Let's look at our example again. So with our trade 1, we've sold the 102 put, and with trade 2, we've bought the $100 put. So the delta for each strike for the 102 put delta was minus 0.1300, and the delta for the $100 strike was minus 0.0858. Now remember, we sold the 102 put. So because we've sold it, it now becomes a positive. It's not something we own. So that short put delta now becomes a positive 0.1300. We own the $100 long put, so the delta remains at negative 0.0858. But when you combine the position together, the net delta position is 0.0442, or 4.42 deltas per contract. And where we get 4.42 is that this is on a per share basis, and in the options market, one contract controls 100 shares of stock. So to get it on a per contract basis, you just multiply your net delta amount by 4.42. But what does this mean? Well, if you have a net delta position of 4.42, for every $1 rise in the value of the QQQ share price, the value of our overall bull put spread position will go up by $4.42 per contract. And for every $1 fall in the value of the QQQ share price, the value of our total option position will go down by $4.42 per contract. Another way of looking at this, it's very similar to owning 4.42 shares of QQQ. Because remember what delta is. Delta is telling you how much will the share price go up, or the value of the position go up, for a $1 rise in the underlying share price. So if the value of QQQ went up $1, if you had 4.42 shares, you'd go up by $4.42. So it's exactly the same as that bull put spread position. So it's just another way of looking at delta. It gives you the equivalency position if you actually own the underlying shares. But the one thing about delta is that delta is always changing. So as the share price moves, so does the delta amount. And that's where gamma comes in, and we're going to talk about gamma in a separate video.